Okay, let's unpack this. We're talking about this massive, and I mean incredibly complex machine that powers one of the fastest growing major economies in the world, the Indian financial system.
Hmm.
This is going to be a deep dive into the architecture, the institutions, the rules, and all the piping that channels billions of dollars every single day.
It's an absolutely essential dive.
Yeah.
For anyone trying to understand the macroeconomic picture,
Mhm.
particularly because, as our sources really highlight, the structure of the Indian economy it's fundamentally shifted.
Right.
We are absolutely no longer talking about an agriculture-first economy. The sources really stress that services and manufacturing now contribute, a remarkable three-fourths?
75%.
75% of the country's GDP.
That is a gigantic engine. And, that kind of rapid sustained growth requires an equally robust, high-capacity financial system. You need the credit channels, the investment vehicles, and the savings infrastructure to keep that engine running smoothly.
Right.
So our mission here is to navigate that institutional framework, that regulatory structure, and to do it quickly, thoroughly, and I think most importantly, functionally.
We want to give you, the learner, the absolute shortcut to a comprehensive understanding. So focusing not just on what these bodies are, but, why they exist and what risks they are actually designed to mitigate.
Mm.
At its core, the fundamental purpose of these financial markets is really the efficient allocation of resources. It's about channeling surplus funds from lenders, so investors, and moving them directly to the borrowers, the businesses that need the capital to expand and innovate.
And before we get totally lost in the sea of acronyms, which is very easy to do,
Very easy.
we need the big picture.
Yeah.
And this leads us directly to, honestly, the perfect analogy that's provided in our source material. It just anchors the entire structure immediately.
Yes. If you can grasp this one analogy, you basically have the operational blueprint. Think of the entire financial market as a massive, complex irrigation system.
An irrigation system, okay.
And this system has to move water, which is the funds, efficiently to where it is needed, to the businesses.
So we've got the system visualized. So the Reserve Bank of India, the RBI, and the Securities and Exchange Board of India, SEBI, these are the chief engineers, they're responsible for making sure the pipes don't leak, that the water flows where it's supposed to, when it's supposed to, and critically, that the water is clean.
Right, meaning the funds are legitimate, the processes are transparent, and, no one is stealing the water upstream.
Exactly. And the institutions that do the heavy day-to-day lifting, the banks and the mutual funds, what are they?
Those are the powerful pumps.
The pumps.
They take the water, the surplus funds, from the main reservoir, which is, all of us, the investors, the savers, and they move it through the system to the fields, to the businesses where it's needed to grow the crops.
And the crops, in this case, are the economic output and the GDP growth that we're all tracking.
That's it.
Without those powerful pumps and those vigilant engineers, the economy just stagnates. That's the high-level picture we need to hold on to as we get into the details.
Okay, so now that we've got the system visualized as this irrigation network, let's look at the basic plumbing, the financial markets themselves.
Right.
These markets are essential because they perform three key functions that really enable sophisticated economic activity. They aggregate otherwise fragmented funds into viable pools of capital. They provide liquidity, and they disseminate relevant information to make sure everyone can make informed decisions.
And when we talk about markets, I think the biggest, most crucial distinction we have to make is based on the time horizon, right?
Absolutely.
Are we funding something immediate, a short-term requirement, or are we talking about a long-term strategic capital investment?
And that is the classic distinction between the money markets and the capital markets. The money markets are where instruments with a maturity of less than 1 year are traded. This is strictly for short-term lending and borrowing. Our sources define this as a wholesale market, and this is a really critical distinction to grasp.
Let's elaborate on that wholesale term, because that implies scale, right?
You got it.
When we say wholesale, we mean massive institutional players, banks, financial institutions, corporations, meeting their immediate, often overnight, funding requirements.
Exactly. The sheer size of the transactions means this market has exceptionally high liquidity and extremely low risk, just because the time horizon is so short.
So this is where institutions are managing their daily operational cash flow, just making sure they have enough liquidity to meet immediate obligations, not funding a new factory.
Not at all.
Yeah.
And if this market seizes up, the entire credit system quickly follows. It's that
Right.
important.
So what are the specific instruments that fuel this massive short-term movement? What are we talking about?
We're looking at things like call money,
Yeah.
which is very short-term, often overnight, interbank lending.
Okay.
Then you have short notice money, so loans with a slightly longer but still very short notice period.
Right.
And then commercial paper, or CP, that's issued by highly rated corporations to meet short-term working capital needs.
And I've heard of CDs, certificates of deposit.
Yep, certificates of deposit issued by banks and financial institutions, often to raise short-term resources. And, of course, treasury bills, or T-bills, short-term debt instruments issued by the government. They're often considered the safest asset in the market.
Okay, so that's the short-term money market. Then we transition to the capital markets.
Exactly. And this is the long-term strategic perspective.
Yeah.
We're funding instruments with a maturity of over a year.
Right.
These markets provide funding through both debt, so bonds, debentures, and equity, which is shares.
This is where businesses raise the funds to finance, multi-year capital expenditure to build that factory or to fund some large-scale tech adoption.
That's it. And within the capital markets, you have the two stages of the life cycle of a security. The primary market is where new securities are issued for the very first time. So think initial public offerings, IPOs.
And that money goes directly to the company that's raising the capital.
Directly.
Right.
Then, once that new security is issued and the funds have been raised, it moves to the secondary market.
Okay.
This is where existing securities are just traded among investors.
And this trading is absolutely crucial because it provides that essential ingredient of liquidity.
Yeah.
If I, as an investor, know I can easily sell my share tomorrow on the secondary market, I'm way more willing to buy it in the primary market today. It encourages capital formation.
Perfectly put.
Okay, moving on from domestic debt and equity, we have to talk about the global, the Forex market, the foreign exchange market. Our sources really underline its significance because it directly impacts the cost of imports for every single Indian consumer. It facilitates massive cross-border global investment, and critically, it helps businesses mitigate currency risk.
And this is where we need to nail down some essential terminology. When you see a currency pair quoted, say, the highly relevant USD INR, it's the first currency. The USD is designated the base currency.
Right.
And the second currency, the INR, is the quoting currency.
Which just means the quote tells you how many rupees you need to buy $1.
Exactly.
Yeah.
And the structure of the spot Forex market is divided into two primary segments that sort of reflect the nature of the transaction.
Okay.
First, you have the core, highly competitive interbank segment. This is where the major financial institutions and banks are quoting two-way prices, both buy and sell prices to each other.
So they're the price setters, the major liquidity providers doing these massive transactions.
They are. And the second is the merchant segment.
The merchants.
These are the actual businesses, the importers and exporters, who need to convert currency to execute a trade.
Right.
And because they are typically doing smaller, necessary transactions, they're considered price takers.
Yeah.
They just execute their deals based on the prices that the banks provide in the interbank market.
And that distinction has real-world consequences for their profit margins, right?
Right.
If the currency moves against them, they have less control because they're price takers.
100%. It's also worth highlighting the role of Financial Benchmark India Private Limited, FBIL.
FBIL, okay.
This is the entity that publishes the daily reference rates for major currency pairs in India. That's a foundational piece of information infrastructure. It ensures a common price reference for the entire market.
So now we move to the engineers of the system, the crucial regulatory architecture. And we can't just transition to this quickly because this is the heart of the deep dive.
It really is.
Our source material makes it so clear that the primary motivation for regulating these complex financial markets, above all else, is pretty straightforward. It's to safeguard the interests of investors.
Absolutely. If the system is perceived as being rigged or unfair or unstable, that investor reservoir it dries up instantly.
Gone.
The regulatory density is a direct result of the complexity of the modern financial products being traded. So we need to detail the Big Four regulators and then dissect the governmental departments that coordinate them.
Let's start with the specialized regulators, the Big Four.
Starting with the securities markets, the capital markets, we have SEBI, the Securities and Exchange Board of India.
Okay, SEBI.
It was established to protect investors and develop the securities market, and its mandate is exceptionally broad.
And SEBI's scope covers the securities markets and, this is important, the commodities market too. Its core functions are comprehensive. regulating the stock exchanges and all their activities, registering and regulating every single intermediary,
Everyone.
from brokers to merchant bankers, proactively prohibiting fraudulent practices like insider trading and promoting investor education, like the referee, the coach, and the police all rolled into one.
That's a great way to put it. And its enforcement power is intentionally robust.
Right.
SEBI ensures compliance by having the power to call for information, undertake deep inspections, conduct inquiries, and audit intermediaries if any suspicion of wrongdoing arises.
And that power is essential for maintaining global capital trust, isn't it? When foreign institutional investors look at India, they need to be sure that the regulator can actually enforce the rules.
Particularly against insider trading. That's the real insight there. Its enforcement power is the foundation of trust.
And furthermore, SEBI also recognizes and oversees what are called self-regulatory organizations, or SROs.
Right. These are industry-specific bodies of intermediaries, so excluding the exchanges themselves, that represent a segment of the market, like an association of mutual fund distributors.
So the SROs are basically market partners for SEBI.
Essentially, yes. They help enforce ethical conduct within their own membership, and crucially, SROs have reporting obligations to SEBI about any violations or non-compliance by their members.
Which creates a layer of self-policing that helps scale the regulatory effort.
Exactly.
Okay, next. The central and most powerful regulator, the Reserve Bank of India, the RBI.
Its scope is immense. It governs monetary policy and the entire banking sector.
And the preamble of the RBI clearly outlines its primary objective, right?
It does. It's to regulate banknote issues, keep reserves to ensure monetary stability, operate the currency and credit system, and maintain price stability while constantly keeping the imperative of economic growth in mind.
That phrase, maintaining price stability while keeping growth in mind, that's the tricky balancing act the RBI performs every single day.
It is. If they focus too much on stability, growth can be choked off by high interest rates. If they focus too much on growth, inflation, the enemy of price stability, can run rampant.
And beyond just regulating all the commercial banks, the RBI also performs the unique and vital role of being the banker to the government.
Yes, it acts as the primary banker for both the central and state governments, performing crucial merchant banking functions, like managing public debt options and overseeing treasury operations.
So it's not just supervising the financial sector, it's an active financial participant for the state. It's managing the country's purse strings.
That's a great way of looking at it.
Okay, then we shift to these sector-specific watchdogs. For insurance, that's the IRDAI, the Insurance Regulatory and Development Authority of India.
And they are intensely focused on two areas, licensing and policyholder protection.
And what does that mean practically for licensing?
For licensing, IRDAI defines the capital and net worth requirements for insurance companies, just ensuring they have the financial buffer to actually pay claims.
Okay.
But policyholder protection is where the regulator really shines. They define rules for contract terms, specifically covering things like the required sum assured, the surrender value of a policy.
Which is what you get back if you exit early.
Exactly. And, most critically, ensuring transparent and quick claim settlement processes.
And they extend that oversight to the intermediaries as well, the agents and brokers.
They do. IRDAI sets qualification and training requirements for insurance intermediaries, and it regulates the commissions paid to distributors.
Which is a very granular, micro-level regulation designed to prevent mis-selling, right? By making sure the agent is qualified and not just incentivized by a huge commission to push an unsuitable product.
Precisely. And on that granular note, one specific detail on general insurance is that IRDAI supervises the Tariff Advisory Committee, which determines the rates for certain general insurance products.
That's a very specific function aimed at ensuring stability and standardized pricing in key risk areas. It prevents cutthroat competition that could undermine the sector's financial health.
Exactly.
Finally, in the Big Four, we have the PFRDA, the Pension Fund Regulatory and Development Authority.
And their scope is focused specifically on regulating the massive long-term retirement planning ecosystem, so the National Pension System, or NPS, and any other specified pension schemes.
So the PFRDA acts as the registrar and gatekeeper for this future capital pool.
Yes, they're responsible for registering all the crucial infrastructure players. The fund managers who invest the money, the custodians who hold the assets, the central record-keeping agencies who track all the contributions, and the trustee banks.
So without them, the integrity of that long-term pension corpus, which is going to sustain millions of retirees, would be severely compromised.
It would.
Now we move to the next layer of the architecture, the coordination layer.
Mm-hmm.
The coordination of these four major specialized regulators, SEBI, RBI, ERDI, PFRDA, it all happens at the highest governmental level.
That's right. Let's start with the coordinating body, the Financial Stability and Development Council, the FSDC.
The FSDC isn't a regulator itself, is it?
No, it's a high-level governmental body that brings together all the regulatory chiefs, and it's usually chaired by the finance minister. Its job is macro level,
Okay.
to monitor and address financial stability across all the sectors, promote sector development, and push for financial inclusion.
So it's like the quarterback. It's making sure no sector-specific regulation accidentally destabilizes another one. That cross-regulatory oversight is essential for preventing systemic risks.
It is, and below that, we have to dissect the Ministry of Finance itself, because it details the separation of duties across 5 crucial departments.
And this structure really shows how broad economic governance is carefully separated from the more granular market oversight.
It does. The Department of Financial Services is the operational overseer.
Okay.
They specifically regulate and oversee the day-to-day functions of the banking system, insurance, and the pension sectors. They administer policies related to public sector banks, term lending institutions, and specific insurance and pension reforms.
Think of them as the executive branch of the financial operational system.
That's a good way to put it.
Mm-hmm.
Then the Department of Economic Affairs has a distinct, more strategic focus.
Right.
This is where the macroeconomic policies are formulated and monitored. So things like deciding on monetary policy goals, managing fiscal policy, and the overall national economic strategy.
So this is the big picture department.
A biggest picture. They also regulate capital markets and their participants and oversee the functioning of stock exchanges. If you want to know the strategic direction of the entire Indian economy, this is the department setting the long-term GPS coordinates.
So just to be clear, Economic Affairs sets the broad strategy and oversees the capital markets, while Financial Services manages the operational health of the existing banks and insurance companies.
Exactly. That separation ensures strategy isn't bogged down by daily management.
It prevents the engineers from getting distracted by the day-to-day pipe leaks.
Precisely. Then you have the necessary financial housekeeping arms. The Department of Revenue controls direct taxes like income tax and indirect taxes like GST through the Central Board of Direct Taxes, CBDT, and the Central Board of Excise and Customs. Meanwhile, the Department of Expenditure manages the financial rules, service conditions for central government employees, and administers financial assistance or borrowings by the states.
So they're the budget managers, making sure every penny is accounted for within government operations.
Yep. And then there is a very modern, specialized department reflecting contemporary policy needs. DPAM.
DPAM.
The Department of Investment and Public Asset Management. Their focus is very surgical. They oversee the disinvestment of central government equity from central public sector undertakings.
So this department is central to managing the government's non-core assets efficiently and raising capital through privatization or strategic sales.
That's their entire job.
We also need to loop in the Ministry of Corporate Affairs, the MCA.
We do.
Because while the RBI manages money flow and SEBI manages security trading, the MCA sets the legal and corporate framework that everything else rests on. It administers core foundational legislation like the Companies Act 2013 and 1956 and the Limited Liability Partnership Act of 2008.
And crucially, the MCA also have a deep role in market health by promoting competition. It administers the Competition Act of 2002, which is designed to prevent practices that have an adverse effect on competition. It ensures level playing field for businesses.
And their role as a gatekeeper of integrity is enormous. They supervise the key professional bodies that act as the ethical gatekeepers of corporate governance.
Right, like the Institute of Chartered Accountants of India, the ICAI.
The ICAI, the Institute of Company Secretaries, the ICSI, and the Institute of Cost Accountants of India. Supervising these bodies ensures the integrity of financial reporting and legal compliance across the entire corporate sector.
And finally, under the MCA, we find the Registrar of Companies, or the ROC.
The ROC.
The ROC is the authority responsible for the registration of companies and ensuring they maintain legal compliance under the Foundational Companies Act. If you want to incorporate a business, you deal with the ROC. It's the foundational administrative backbone of corporate existence.
So we've established the engineers and the high-level coordinating bodies. Now we get back to the actual mechanism for moving capital. The pumps.
Mm-hmm.
If the regulators are the engineers, the banks and lending institutions are the powerful pumps moving the water from the reservoir to the fields. They are absolutely critical to capital formation.
That's right. They perform the quintessential function of financial intermediation,
Mm-hmm.
accumulating dispersed savings from households and businesses and making that credit available in productive quantities for economic activities, driving GDP growth.
And the coordination of oversight for these pumps is managed by the Board for Financial Supervision, the BFS, which operates under the RBI.
Yes, the BFS provides guidance for the consolidated supervision of commercial banks, cooperative banks, financial institutions, NBFCs, and primary dealers.
And the emphasis there is on consolidated supervision, right?
It is. You can't look at a commercial bank in isolation if its NBFC subsidiary is engaging in high-risk lending. The BFS ensures a holistic view of systemic risk across all major lending categories.
Okay, so within the bank categories, the scheduled commercial banks are the primary drivers of the economy.
They are. This massive category includes the public sector banks, like SBI, private sector banks, like HDFC Bank, foreign banks operating in India, and the highly localized regional rural banks. These are the traditional full-service pumps.
But the nature of banking has evolved. Banks aren't just lenders anymore. They are also massive distribution intermediaries.
That's a huge point. They actively serve as conduits for third-party products.
Right.
They tie up with mutual funds, portfolio management service, or PMS providers and insurance companies to offer advice and products directly to their clients, leveraging their massive customer base.
And that blurring of lines requires careful regulatory oversight from the BFS.
It does.
Beyond the traditional commercial banks, we see the rise of these highly specialized pumps designed for market access and financial inclusion. The first are the payment banks.
And their purpose is extremely targeted. Financial inclusion for low-income households and small businesses by providing basic small savings accounts and remittance services.
But crucially, their restrictions are significant and very deliberate. They're designed to limit systemic risk.
Yes, payment banks are restricted from undertaking lending activities, so they cannot fund the fields directly, and they cannot issue credit cards.
And most notably, their deposits are strictly limited to 100,000 rupees per customer.
That's right.
That limit is fascinating. It defines them as a secure, low-risk utility rather than a full-service banking powerhouse. It ensures they provide financial infrastructure without becoming a source of systemic credit risk.
In contrast to payment banks, the small finance banks, or SFBs, are designed specifically to supply credit.
Okay.
Their primary purpose is to fill the credit gap left by major commercial banks by serving small businesses, marginal farmers, micro and small industries, and other entities in the unorganized sector.
So they're like smaller pumps designed to reach the marginalized fields that the major irrigation canals might miss.
That's the perfect analogy for them.
Next, the group that often confuses the learner due to their bank-like appearance, non-banking finance companies, NBFCs.
Right. These are companies engaged in specific financial activities, like providing loans and advances, leasing, hire purchase, insurance, or chip business.
And the sources are so clear. They look like banks, but they are not.
They are not. The differences are crucial from a risk and stability perspective.
So what are they?
NBFCs are fundamentally different from banks in two key regulatory ways. One, they cannot accept demand deposits.
Meaning the money you can instantly withdraw or use to issue a check.
Right. And two, they do not have deposit insurance from the DICGC, the Deposit Insurance and Credit Guarantee Corporation.
That lack of deposit insurance is a major distinction in terms of consumer risk. Functionally, how does the end user experience the difference between borrowing from an NBFC versus a major commercial bank?
Well, often NBFCs specialize, which means they can offer faster, more bespoke lending, sometimes with less stringent collateral requirements than traditional banks.
Okay.
However, that often comes with a trade-off, a potentially higher cost for the borrower, reflecting the higher underlying risk and the absence of deposit insurance.
So they're often quicker, more flexible pumps, but maybe with a slightly higher operational cost.
That's a good way to think about it.
Within the NBFC landscape, we have the highly specialized housing finance companies, HFCs. And our sources noted an important regulatory shift here. This is a key takeaway on centralized oversight.
Yes, the regulation of HFCs has recently been taken over entirely by the Reserve Bank of India.
And that centralization of oversight reflects a move toward greater systemic stability, doesn't it?
It does. HFCs are highly interconnected with the broader financial system, and previous episodes of Stress show that fragmenting their regulation created blind spots. Bringing them under the RBI's umbrella ensures a uniform, stricter standard for risk management.
Finally, we observe the rise of modern lending mechanisms enabled by technology. P2P lending or peer-to-peer lending.
Which is defined as unsecured lending, where one person lends money to another through a regulated online platform.
And the key word there, again, is regulated.
Always. Recognizing the potential for unchecked risk, P2P lending platforms are also regulated directly by the Reserve Bank of India. This just demonstrates the RBI's expansive reach, ensuring that even innovative digital pumps are safe for the overall irrigation system.
We've covered the regulators and the funds movers. Now we get into the actual pipes and channels, the infrastructure that makes trading, settlement, and information flow possible. This is the complex plumbing behind the scenes that guarantees trust and efficiency.
And first, a quick technical clarity point. What exactly is defined as a security in these pipes?
Good question.
The Securities Contracts Regulation Act, 1956, or SCRA, 1956, defines securities very broadly. Shares, stocks, bonds, debentures, derivatives, units of collective investment schemes, and government securities.
So basically all the assets flowing through the system.
That's right. So once a trade is executed, it has to be guaranteed and settled, and that's the job of the clearing corporations.
Right.
Their primary function is guaranteeing transactions, ensuring confirmation, settlement, and delivery of trades, and setting up rigorous risk management systems.
That guarantee function is the most critical element, isn't it?
It is.
If I buy 100 shares from you, the clearing corporation guarantees that I will receive those shares and you will receive the money even if one of our brokers fails in the interim.
Exactly. They are the essential shock absorbers that prevent cascading defaults within the system.
Then we have the institutions that manage the actual holding of these assets, the depositories.
Which are the institutions that enable the electronic holding of financial assets, equities, mutual funds, bonds. They essentially function as massive electronic vaults.
And in India, we have two primary entities, National Securities Depository Ltd, NSDL, and Central Depository Services Ltd, CDSL.
Right. They hold the records electronically. But investors don't deal with NSDL or CDSL directly. They deal with their agents, the depository participants, or DPs.
So the DPs are the ones who open investor accounts, the DMAT accounts, to hold securities in electronic form.
Yep. Think of the DP as the retail interface, like your local bank branch for your digital holdings.
And it's important to clearly distinguish DPs from custodians, as they often get confused.
They do. Custodians typically work with large institutional investors, pension funds, foreign banks, large mutual funds managing huge pools of assets.
Right.
Their role is logistics, managing bank accounts and handling the delivery of securities and money after a trade settles.
So they manage the institutional delivery logistics, whereas DPs are focused on managing individual, smaller investor accounts and dematerializing their holdings.
That's the key difference. We also have the essential backroom operations handled by R&T agencies, registrar, and transfer agencies.
And what do?
They maintain detailed investor records and handle crucial communications and processes like dividend payments, interest payments on bonds, and e-voting communications for shareholders. They are the silent administrative engine.
And for streamlining the administrative burden, there's the KYC Registration Agency, or KRA.
Right. This agency maintains central databases of investor verification details, KYC, Know Your Customer, which reduces the hassle of submitting documents repeatedly every time you interact with a new intermediary.
It saves time and friction across the entire ecosystem.
And while all this infrastructure works, we have to acknowledge the most visible intermediary, the stockbrokers.
Of course.
They're right at the forefront, earning their revenue primarily through commissions for putting through buy and sell transactions for investors on the stock exchanges. They are the conduits between the investor
Just as vital as the flow of funds, trust in lending requires transparent risk assessment, and that's powered by the credit reporting system.
Yes, and this system includes multiple credit information companies, or CICs, such as Sybil, Experian, Equifax, and CRI Marker.
And these entities collect, analyze, and report data on borrower credit history governed by statutes that cover information flow and privacy.
And crucially, the sources note the democratization of this data. The RBI directs CICs to provide one free full credit report, or FFCR, including the score, to individual borrowers for free once every calendar year. This allows every citizen to check the health of their own financial standing.
A newer and honestly truly transformative piece of digital infrastructure is the account aggregators, or KLAs. They're licensed by the RBI.
And their role is to consolidate different parts of customer information bank statements, tax filings, insurance policies, and share it with authorized third parties, but only with the customer's explicit express consent.
This is a major game changer for digital lending and financial planning.
It is.
By ensuring proper, verified, consolidated data is available in a consent-driven manner, TELEs facilitate the digital lending process. They drastically reduce paperwork, improve underwriting accuracy, and make the borrowing experience so much easier and faster for the consumer.
It's basically digitizing trust itself.
Right. Shifting back to assets, let's quickly define the debt market, often just called the bond market.
This is the segment where debt securities like corporate bonds, debentures, and government securities are listed and traded. It's distinct from the equity market and represents the massive flow of borrowed long-term capital.
And another key segment, often used by sophisticated investors, is derivatives.
Right. A derivative is an instrument that simply derives its value from an underlying asset, which could be anything from equity or debt to commodities, currencies, or interest rates.
And they're used primarily for hedging risk, like an exporter hedging against currency fluctuations, or for speculation on future price movements.
Which is why their complexity demands strict regulation from SEBI to prevent excessive systemic risk.
Okay, finally, let's turn to the specialized professionals who manage the flow of investment advisors.
These are licensed professionals who guide clients toward achieving financial goals by creating effective portfolios and helping them understand complex products. Their key mandate is fiduciary duty toward the individual client.
And investment banks play a different role. They're the strategic advisors to large corporations and governments.
Yes, they offer expert advice on massive structural moves like capital requirements, expansion strategies, complex project financing, and critical activities like mergers and acquisitions, M&A. They handle the big structural flow of money.
And then we have to contrast the professional fund managers. Let's talk about mutual funds versus portfolio managers.
A key distinction. Mutual funds collect money from multiple investors. That's the pooling of money into a massive common reservoir. And they channel those funds based on a specific, publicly stated mandate. They're managed by asset management companies, or AMCs.
Right. In contrast, portfolio managers create and manage individual bespoke portfolios for sophisticated or high net worth investors.
And critically, without pooling those funds, the investment strategy is tailored to the individual client's needs and risk tolerance.
And for the very highest end of sophisticated investors, there are alternative investment funds, AIFs.
These are privately pooled investment vehicles for sophisticated investors, deployed according to a defined policy like venture capital or hedge funds. And they have a strict limit mentioned in our sources, a maximum of 1,000 investors through private placement, reflecting their high-risk, specialized nature.
The final piece of the information puzzle, vital for the debt market, is the credit rating agencies, or CRAs.
They assess the financial position and debt servicing capacity of issuers, and they provide a standard rating from AAA down to D that indicates the risk of default on debt securities. This rating is the universal language of risk for every single debt investor.
We've covered the short-term liquidity, the long-term capital flows, the regulators, and the infrastructure. We have to now turn our attention to the long-term aspects of the system: personal protection and retirement planning, primarily done through insurance and pensions.
And it's crucial to recall the historical context here. The sources remind us that the life insurance sector was open to private providers relatively recently, in 2001, which spurred significant competition and product innovation after decades of state monopoly.
The life insurance categories break down conceptually into three types: traditional products like pure term and endowment policies, variable products, and the highly popular unit-linked insurance plans, or UIPs.
The most fundamental product, and often considered the best value for pure protection, is term insurance. This is pure risk transfer. It pays the lump sum assured only if the insured event death occurs within the specified term. That's a very clean product because it has no maturity benefit.
So you buy the protection, and if you survive the term, the policy just expires.
That's it. In sharp contrast, the unit-linked insurance plans, ULAPs, are a dual-function product. They combine risk cover with an investment component.
Okay.
So a portion of the premium covers the mortality risk, while the remainder is invested into specific market funds to provide returns based on portfolio performance. This combination of investment and insurance requires very careful regulatory oversight due to its complexity.
Moving to general insurance, this covers all the non-life risks: motor insurance, health, travel, fire, personal accident policies.
Right. And this sector relies on specialized infrastructure for claims management.
Uh-huh.
And the distinction here is important.
So for general insurance claims, particularly those involving physical damage like a car or a fire, companies use surveyors and loss assessors.
Mm-hmm. Their specific job is to assess the damage and determine the exact quantum of the financial loss to ensure a fair claim payout.
But for health insurance claims, the processing is handled by third-party administrators, or TPAs.
Yes, and TPAs specialize in the complex medical billing and verification process, liaising between the hospital and the insurance company to process the cashless or reimbursement claims.
So that specialization damage assessment versus medical billing is the key distinction in the claims process.
It is.
In terms of distribution, there is a clear distinction between brokers and agents.
Yes. Brokers can offer policies from any company, which allows them to provide a wider selection, and they are paid commissions by the company.
And agents, on the other hand, typically represent specific insurers and are thus limited to offering only that insurer's products.
Exactly. Finally, the foundational element for long-term stability, the pension market. And this market is expanding rapidly because a larger portion of the population is outside formal government retirement coverage and has to rely on its own systematic savings for retirement.
Right. In the private organized sector, the retirement benefits are largely supervised by the Employees Provident Fund Organization, the EPFO.
The EPFO acts as the primary agency, ensuring that contributions are managed and distributed for the large volume of private sector employees.
And the pension structures themselves come in two main philosophically distinct forms.
They do. The defined benefit structure, which is increasingly rare, provides a fixed, predetermined pension amount based on salary and years of service, generally without explicitly requiring an employee contribution.
And the key here is that the risk is entirely on the provider, the employer or government.
All of it. Conversely, the dominant modern structure is the defined contribution model. The amount you receive at retirement depends entirely on the accumulation of funds from both employer and employee contributions over the working life, plus the returns generated by the investment of those funds.
So the critical point is that the risk of market underperformance is borne by the employee, which requires systematic savings and investment discipline.
Exactly.
Yeah.
And the quintessential example of the defined contribution model is the National Pension System, the NPS, regulated by the PFRDA.
Right.
It's a voluntary defined contribution retirement savings scheme designed for systematic, long-term saving during a working life. It's open to both government employees and the general public to build their retirement corpus, and it squarely places the responsibility and the risk onto the individual.
Wow. Okay. We have successfully navigated the vast, granular, and complex architecture of the Indian financial system. It truly is a testament to complexity engineered for scale. I mean, think about the sheer detail we've covered, from the high-level macroeconomic strategy formulated by the Department of Economic Affairs, down to the micro-level rules defining standardized rates by the Tariff Advisory Committee under IRDAI, and the specific restrictions on deposit limits for payment banks.
It is a deeply layered structure, and we've seen that sustained economic growth is critically dependent on every single part of that irrigation system functioning correctly.
Right.
You need the regulatory engineers, the RBI and SEBI, to maintain price stability, promote fairness, and ensure protection. You need the pumps, the banks, the SFBs, and the specialized NBFCs to ensure liquidity and efficient credit allocation to every corner of the economy.
And you absolutely need the pipes and channels, the clearing corporations that guarantee transactions, the depositories that hold digital assets, the KRAs that streamline documentation, and the account aggregators that are fundamentally digitizing trust and data flow to reduce friction and make necessary information available.
Yeah.
And the FSDC and the MCA sit at the very top, coordinating this massive flow of governance and capital.
Well-regulated markets, as our source material continually stresses, are the only way to promote sustained high-speed growth. Because they ensure price stability, they guarantee liquidity, and they provide necessary protection from financial shocks, which is the foundational requirement for encouraging necessary long-term investment.
So, bringing our irrigation analogy back for the final time. This highly detailed system is designed to prevent the water from stagnating or the fields from drying up. It is vast, it is detailed, and it requires constant critical maintenance and oversight across every single sector.
From credit reporting systems to pension fund registration, it's everywhere.
Exactly.
Which leads us to our final provocative thought for you to consider. Given the critical oversight required across such diverse sectors, from the RBI regulating niche payment banks and P2P lending platforms to the MCA supervising professional bodies like the ICAI, this vast, multi-layered regulatory structure is fundamentally designed to safeguard national stability above all else. The final challenge for the learner is to consider the implications of such widespread granular oversight. How does the constant push and pull between the government's overriding need for macroeconomic stability, managed largely by the RBI and FSTC, and the individual regulators' focus on granular investor protection, ultimately define the future trajectory of a rapidly transforming, ambitious economy?
Something to keep in mind as you watch the headlines and look for the next wave of transformation.